Okay, so good morning and welcome to Wake Up Real Estate. It's Monday, which means it's a Mortgage Monday, and we're going to talk about the 5-day HELOC, the 5-day HELOC, and some other stuff that's going on the mortgage front that I think should be encouraging for most of you in some way, shape, or form. Good morning, Mike, and Mark Webster says a money Monday. I like that as well, right? Mortgage and money Mondays, absolutely. No Ryan today. Ryan is traveling, so no. Hi. Well, I don't know what I'm doing here. I might have to shut down the. Hold on. I had random people, so I must have hit a wrong button. I had random people. I was testing something different. I was also live streaming this on my phone to TikTok, but I had random people coming on as a host. So we'll have to figure that out. Maybe Jordan and I will test it later so that we can get it the kinks worked out for tomorrow's deep dive session. So just some housekeeping items real quick at the top here. We're going to talk briefly about the 5-day HELOC today, but we're going to do a deeper dive on the topic tomorrow at 1 Eastern. You can register for free at heloclass.com, HELOCCLASS.com, heloclass.com. And I think, or I hope, I've set it up so that if you miss the live session, you can go there after the fact and you can check it out on demand after, if you miss 1 o'clock Eastern tomorrow, you should be able to check it out on demand there. And of course, we'll get it added to the Wake Up Real Estate YouTube channel and to wakeup.realestate as well. Jordan, before we talk about the 5-day HELOC, can you talk a little bit about the activity that we saw from, say, Friday or even like mid-late week through the weekend as far as buying activity and application activity and contract activity, etc.?
It's up significantly. Yeah, it's up significantly. So in the terms of buyers re-entering the market, it's up quite a bit. There are about 5 times more application this last week than it was the previous weeks. So interest rates dropping as quickly as they did. Is the primary factor of it. Interest rates have dropped a full percent from last month at this point, and they continue to start inching their way down. We'll probably see a lower transition in the interest rates dropping over the next 12 months. We kind of get our big jumps this last month and a half. And then we'll probably slow down, and then we'll slowly see us trickle into the 5s, hopefully into the 5s, next year, hopefully next year, 2024, 2025, at least. With that being said, a lot of questions. I just had a 30-minute conversation right before I got on here about kind of what to do with your interest rate, because you can buy down, right? I quoted someone today a 5.25 on a with a $10,000 buy down on a $300,000 house. So can we get into the 5s right now? Yes, we can. It's just going to cost money. Is it recommended? I'm personally not recommending buy downs, just because they're not going to make their money back quick enough by the time I think interest rates are going to drop. If there is projected to drop in the the 5s in the next 12 months, they're not going to have enough time to get their money back on the savings of those payments. But maybe it's a comfortability factor too, right? Maybe it's, hey, I want the best rate offered today, and then I want to buy down again when when the refis come back around.
So let's unpack some specific scenarios. So there are builders in my market that are offering some significant incentives towards closing costs. Given what you just said, what would you recommend a borrower who decides, I trust what you're saying, Jordan, that makes sense to me. How should I use the incentive that the builder is offering already?
If it's an incentive that's already being offered, I would use it no matter what, right? If it's there.
Would it make sense? Let me ask this. Would it make sense for them to see first and foremost, okay, Mr. or Mrs. Builder, you're offering 10,000 towards closing costs or 20,000 towards closing costs. Can we just slash that off the price? Now, some builders may be hesitant because that number, that price of the home does affect the value of the entire neighborhood. So if they're building others, that could affect. But with that, if that's on the table, would that make sense, Jordan? Because
yes,
my thought is you can't renegotiate the price in a year or 18 months or 24 months, but you can renegotiate your interest rate in a year or 18 or 24 months.
So ultimately it's going to come down to the client's preference, right? To me, I advise them what mathematically makes sense, but at the end of the day, it's still going to be comfortability factor, right? It's going to be, what are you comfortable with? Is it your payment, or is it getting the best deal possible for you and your family? Yeah. Is it cash to close, right? It could be they want some of that incentive just to bring their cash to close down and not necessarily buy their interest rate down.
Exactly.
But let's just say they have the cash to close. They're not really worried about it. They're just trying to look for the best deal possible. Yes, mathematically, if they got $20,000 off the price, they're not going to get as bang of the buck today. But then if they turn around in 12 months and refinance again, they're refinancing $20,000 less and dropping their interest rate in 12 to 24 months. Would it be beneficial? Yeah. And it would be beneficial to buy the interest rates down then, right? And get into the fours, right? We're going to see interest rates locking in the fours probably in the next 12 to 24 months. But that's going to cost them money to get there, right? It's going to, they could save their buy down now and then buy down later. But mathematically, there's always a number. There's always a way we can mock up the numbers and say, hey, how much money are we going to save on that 20,000? How much is it going to cost us if we do a buy down with it? What is it going to look like when we refinance in 12 to 24 months? And then we can mathematically say, this is how much money you'd save, or this is how much money you'd lose.
This is a perfect illustration that every situation and scenario is a puzzle. So there's no one simple blanket answer given every scenario. Because as Jordan was talking there, I was thinking, okay, well, maybe they're offering 20,000, but we don't want to buy it down because they've got, they've got a car payment that they could use that 20,000 to pay off the car. Now they're significantly lowering their monthly cash flow, and then they can refi in 12, 18, 24 months to renegotiate that interest rate and thereby getting themselves even more monthly cash flow, right? So it's about looking at their total financial picture, or all of the pieces of their financial puzzle, and fitting it together in the way that makes the most sense and that they're most comfortable with, right? That because some folks have different levels of tolerance when it comes to the things that Jordan mentioned, right? For some of them, it is absolutely getting the very lowest rate they can possibly get right now. And some of them, it may be getting the best deal. And some of them, it may be how can they best impact their monthly out-of-pocket costs, right? Like how can they lower their monthly fixed out-of-pocket costs? So it's a matter of looking at those pieces. For those, some of the different scenarios, just to get your gears turning, if you're listening and you don't have much in the pipeline. So we have, activity-wise, we have several investors we're shopping DSCR loans for. We have several first-time buyers that we're pre-approving with down payment assistance. Mm-hmm. We have, what else do we have that we've been working on, Jordan, scenario?
Helocs, maybe.
I have a builder. Hold on. I have a builder that we're looking at some financing options because he wants to scale up the number of homes he's building next year. Sorry, go ahead, Jordan.
Yeah. Mainly investors right now, HELOCs, pulling equity out, investing in more real estate. Those guys kind of lingered around, but then new home buyer applications have increased significantly. So first-time home buyers, now that interest rates drop, DPAs, and I know we mentioned it on the last couple of shows, and we did a webinar over it, where DPAs make more sense now, right? So those products are being pushed by lenders a little bit harder. Same with buyers are looking into them a little deeper. But yeah, just looking for options that are instantly forgivable on DPAs, and that way you can still participate in the refi boom here in the next 12 months.
If you had missed any of that, that was 2 weeks ago. We did Mortgage Monday 2 weeks ago, and our Tuesday info session was about down payment assistance. Last week, we were talking about DSCR. Today and tomorrow, we're talking about the 5-day HELOC. Okay, so what is the 5-day HELOC? Just very briefly, some bullet points. Number one, it's a very simple, fully online, automated application. Clients can apply in 5 minutes or less. They can get funding in 5 days or less. If it is not a primary residence, it could be as little as 2 or 3 days. They can get up to $400K, and it can be on a primary, a secondary, or even non-owner occupied, and it can be first, second, or third lien position. Okay, so very flexible, lots of options. The rates are going to be higher than a fixed 30-year refinance, but the costs are also less. And for most folks, it's still potentially a better cash flow play, depending on what they're using the funds for. Are they using it for renovations? Are they using it to consolidate debt? Are they using it to invest, maybe to buy another property? And I've been running some advertising and creating some short form videos that maybe you've seen on here, and I'm getting some great activity. I've had 7 applications for HELOCs since Friday morning, and I spoke with 2 of the applications this morning, both of which own multiple properties. So I'm having. Why do I highlight that? Because you may be a real estate agent thinking, well, how does this help me, right? Well, number one, let's talk about how you can add mortgage revenue as a additional income stream, which you can schedule a time to chat with me at josh15.com. Okay, number one. Number two, when you play the role of knowledge broker and bringing value and helping your clients, they are naturally going to look at how can they reciprocate that help back to you by referring you other clients, or by you raising the idea in their mind about this HELOC program. It may lead to a deeper conversation where maybe instead of the HELOC to renovate the property, maybe they should just buy a new home and let you help them sell their own home, right? So it's about having conversations. 2 conversations this morning that I had, both owned multiple properties and both have a ton of equity in both properties. Oh, I take that back. One had a ton of equity in both properties. One had a ton of equity in one, but had just recently purchased the new one. So there wasn't a ton of equity on that one. Point is, they're homeowners and they've got equity and they're looking to do something. They need some help, and you can play the role of providing help.
A lot of people think they're locked in. They got a rate in the 2.5. I'm locked. I'm done. I can't do anything else. I'm stuck in this house. Like, a lot of people think that way, and it's not true, right? You got HELOCs and all things to where they can pull equity out. They can buy new homes. They can always keep that home, right? It's almost free money. At least keep it, but you might be able to help them buy another, right? Or invest in another. Maybe they stay there and they invest in more.
And what Jordan said is exactly how I'm leading most of my my social content, right? Would you be interested in tapping your equity without losing your current low rate, right? Because that's the objection going on in their mind. They don't want to lose that low fixed rate, which, by the way, I don't know the numbers on this exactly, but I've heard them recently. You'd be surprised. It's really only like 30% of primary mortgages are locked into the super low rates, right? So it's not even as many folks as you may think or believe or have in your mind as an objection. So if this topic is of more interest to you, we're doing a deeper dive tomorrow at 1 Eastern. Tomorrow at 1 Eastern, you can register for free. HelocClass.com. It's scrolling across the bottom for those of you watching on video. HELOC, HELOC Class, CLASS.com. And I will show on that session. Well, first of all, we'll get into more of the the nitty gritty, and we'll also explore in a little bit more detail why this is a great reason or example of why you might consider adding mortgage revenue to your business in 2024 and beyond, because this is a great way to help more of your clients provide value and service to them and be compensated monetarily when you do. So you want to check that out. But also, I'll share some of the marketing and some of the strategies I'm using that you can R&D for yourself. And some of you listening here, you may be interested. You may want to tap some of your equity without losing your low rate. If that's the case, go to joshvips.com, joshvips.com/HELOC, joshvips.com/HELOC, which, by the way, if you can't find any of these links or you need help with anything, if you just go to wakeup.realestate and use the chat widget bottom right, Mike can help you with any and all of that. And also, so Jordan, maybe just briefly, we'll talk about this is an automated HELOC solution, but we have other HELOC solutions. We have fixed or closed-end second mortgage options, right? So like both of the people that I was having a conversation with, the initial HELOC offer probably wasn't an ideal solution for them. And that's one of the main reasons why Jordan and I, are at NEXA Mortgage, is we have so many options and programs and products that we can better help or facilitate, putting people into the right financial instrument, that fits what they're looking to do or their current financial, status or situation, right? All right, let's. I think we're going to keep it short and sweet here because it's a Monday, and I know that we've got. I got another app that just came in while we were live here, and we're working on some quotes, as I mentioned, DSCR quotes, etc. So we're going to keep it short and sweet here. And for those of you that want to do the deeper dive, just go to helocclass.com, helocclass.com. And many of you will be hearing from us today or tomorrow or this week, because we've got clients of yours that we've got pre-approved and shopping, or you've referred somebody and we're working on that, or whatever the case may be. So you may be hearing from us one way or the other. Facebook user, gotta love the anonymous Facebook user. I don't know why StreamYard sometimes block that. If a person is a loan originator, can you get your own loan? So at NEXA Mortgage,
no,
we can. You can't do your own loan. Okay, that's not legal.
Well, there's some companies do it, and that's treading the line. Okay.
Yeah.
Most mortgage fraud is committed by mortgage loan originators. Let me put that out there. Okay. There's not a reason for you wanting to do your own home loan, because when you have an employee, when you're an employee of a mortgage company, they don't make money off of you, right? When you do, it's an employee pricing loan. You get you get better than everyone else out there. So there's not really a point to do your own home loan. Why not get that pricing and not have to do the work, really? I guess, if someone really wants to, but you're still heavily involved. I mean, if you're doing mortgages and you're doing your for me, I know exactly what I need when I turn it in. It's not like it's basically whoever's working your home loan is, you're just giving them all the docs. They're turning it. They're just an interim. They're not. They'll give you the approval letters and things like that. It's not as needed, but there is someone involved, a part of the internal team for compliance reasons. They want to make sure that NEXA doesn't go under because some loan officer tries to do something dumb,
shady or stupid or whatever.
Yeah.
I'm going through that myself. I'm getting, I'm employed with NEXA, and we're refinancing a property, and we're getting a heck of a deal as being an employee with the company. So to become a loan originator, do you have to get a license? So with our reload program, you do have to be licensed. You get your NMLS number, you take a 20-hour class, and you have to pass a test. And if you'd like to explore that in more detail, you can just schedule a time for us to chat or shoot me a private message, etc. How do I want to say this? I would say that for most, or the requirements in many cases are less than to get a real estate license. So, for example, in Pennsylvania, it's 75 hours of pre-licensing class that you have to take. For a mortgage loan originator, it's 20. Now, the test is, the test isn't a piece of cake.
But if you want to, again, if you want to expand to the states, like if you, for example, in a surrounding state, get your real estate license in a surrounding state, it's more where your mortgage license might not be.
Right.
It's about the same, or maybe an hour or two more is the average versus, another 40 hours or 30 hours in real estate. And the cost is a lot less, right? To get your mortgage license, cost is about $500, $500 to $700, depending on your states, how many states you pick up. But just one state is fairly cheap to get going.
Great questions. As an originator, is that just for one state? Yeah, good. So you can get licensed in multiple states. Some states have additional hours. It's usually minimal. Some have a little bit more than others. But if it's something you're thinking about,
you don't take tests on those.
Right.
Once you pass the national, you're pretty much done.
Yes, 100%. And then the only additional requirements to add states is additional hours depending on the state. Some states don't. Some have it's 1 hour, some it's 2, 3. I think the most, there's one that's like 8 or 10. I forget what state that is, but
like Utah or somewhere.
Yeah. So again, if you'd like to explore that, I'd be happy to chat. All right, good stuff. So tomorrow, housekeeping items as we wrap up. Tomorrow morning, Texting Tuesday, as always, 10:30 a.m. Eastern, and then we'll be doing a deeper dive info session on this 5-day Heloc product and some of the other, related programs and products that we have available as well. HelocClass.com, HelocClass.com. On Wednesday, for our Wednesday mastermind session, we have Elliot Tomaszewski coming back with Zudelio. That's at 1 Eastern. We're going to do a deeper dive demo and mastermind and collaborate with him. You can register for those at wakeup.realestate/MM. And one last housekeeping item. We're going to be live this week, but then we're going to take a 2-week break for the holidays, and we'll be back Tuesday, January 2nd. Now, you can still expect some content from us. I think Jordan and I will probably still do a mortgage info session next Tuesday, and there'll be some other things that will content that we'll release. But as far as the live Wake Up Real Estate shows, no shows from next week, the following week, and back on January 2nd. Jordan, thanks for hopping on a Mortgage Monday. Excited to have you on tomorrow at 1.
Yeah.
And hopefully we'll see everybody tomorrow morning.
Sounds good. Thank you.